Let's get your trading day started. Live from New York City this morning. Good morning, good morning. Your equity market negative by 0.2% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, brace yourself. The Fed speak resumes. Cyber Monday forecasts are revised higher, and Reddit testing the water for an IPO. We begin with the big issue. Welcome to the 5K Club.
5,000 is starting to be a number we're hearing a lot.
The S&P 500 can hit 5,000 by the end of the year.
To 4,650, maybe 4,700.
4,700.
If the economy remains strong, there could be even further upside to 4,700.
We do have one model that can take us up to 5,300.
All the things are moving in the right direction.
Certainly the probability of a soft landing has gone up materially.
The basis is forming for a move up in equities.
Better earnings environment in 2024.
We're actually positive for 2024.
Stocks are going to grind higher.
We can certainly see the market continue to hit new highs.
Will be at new record highs for the S&P 500 early next year.
The path for equities is higher next year.
We're higher by the end of 2024 than where we are today.
We do have to pay attention to that bull case heading into next year.
Joining us now to discuss, Bloomberg's Katie Greifeld and Ira Jersey of Bloomberg Intelligence. Your team coverage starts right now. Katie, the 5K Club, seeing it across the board, aren't we?
Yeah, the bulls are back, at least when it comes to 2024 sell-side targets. Deutsche Bank and BMO out in front with actually a 5,100 year-end target for the S&P 500. Then you have Bank of America and RBC just behind at 5,000. Those are some of the most optimistic calls. That would push the benchmark above 2022's record high. Then you have Barclays and, of course, Mike Wilson from Morgan Stanley at the bottom there. They see the S&P 500 roughly unchanged from where we are right now. But all told, the average target calls for a 3.5% increase next year. That is a starkly different setup than where we were this time last year. Remember, the headline last year was that the average forecast actually called for the S&P 500 to decline in 2023. The first time that the sell-side consensus had been negative since at least 1999. The median target was just 4,000, and as you can see, that clearly didn't materialize. We've been over 4,000 since March, and all told, the S&P 500 up nearly 19% this year. So we'll see how this current batch pans out.
Katie, that's the equity market story. Ira Jersey, based on your bond market forecast, are you looking for a so-called everything rally going into next year?
Yeah. Well, certainly if you get up toward 5,000 on equities, it would probably be an everything rally. So the consensus is that for just below 4% on the 10-year Treasury yield, our forecasts are for yields significantly lower than that, actually closer to 3% than to 4%. And that's predicated on the idea that we are going to have slowing growth as opposed to better growth. So, I think that would be somewhat of a disconnect maybe to the idea that you're going to see massive earnings in the for a lot of companies out there. I think the economic environment and the optimism in say risk asset markets versus what the bond market participants are saying is becoming more disconnected than it was maybe for the last 6 months or so.
Ira, the standout call for me really jumps off the page is Deutsche Bank. Deutsche Bank is forecasting recession. They're projecting 175 basis points of cuts from the Federal Reserve next year, and at the same time, Binky Charter's saying 5,100 on the S&P 500. Ira, from where you're sitting, what is the rate cut call?
Yeah, I think that the Fed is going to be more reluctant to cut interest rates, but I think in their hesitation, the bond market actually can rally more than what than rate cuts. So remember that like 5-year Treasuries, 10-year Treasuries don't need the Federal Reserve to cut in order for interest rates to be meaningfully lower, because that's just the expectation then that the Fed's going to cut further. So our call is for an early recession in early 2024, but for just a modest recovery from there. So the Fed might feel comfortable just leaving rates on hold for a lot longer I think then certainly that pretty pessimistic call. And the Fed may start to cut interest rates next year, but I think if they do, it's slow and it winds up being later in the year as opposed to early.
A ton of Fed speak later this week. It climaxes with Chairman Powell on Friday. Ira Jersey, Katie Greifeld, thanks for joining us. We'll catch up with Katie around the opening bell, about 25 minutes away. Equity futures just a little softer. Let's get to some coverage, get to the panel. Morgan Stanley's Mike Zezas, Lisa Hornby of Schroders. Lisa, I've been told repeatedly by Citi Stuart Kaiser that this equity market rally is built on good data, and that when that good data starts to turn, he's going to turn the other way and run fast. Lisa, that outperformance of the US economy this year, are you expecting that to continue into next year?
I think it will be more surprising than people expect. I mean, this year, when you think about the things that ended up supporting the economy in 2023 that the market wasn't anticipating, it was larger than expected uptake of fiscal stimulus programs on behalf of the various CHIPS Act and Inflation Reduction Act. It was the consumer having more dry powder than people expected, and it was the economy being a little bit more resilient to the level of rate hikes than people expected coming into the year. Next year, I think all three of those are a little bit more challenged than they were in 23, which should be a little bit more pessimistic for the outlook for the economy. I mean, right now, as you said it, and your guests earlier in this morning said it, the market's looking for Goldilocks. Rates are going to rally, the Fed's going to be supportive, and equities are going to rise to all-time highs. That seems very, very optimistic to me, particularly given the fact that we've had the most aggressive rate hiking cycle in many, many years. So, I would probably take the other side of that resilience, or that economic resilience.
It is amazing we're talking about this slowdown into next year, Mike Zezas, given where unemployment is south of 4%, given where claims are in and around 200K, and given the fact we've just seen a record for shopping on Friday and a record for shopping on Monday. This according to Adobe. Shoppers spent $12.4 billion on Cyber Monday. Spending increased 9.6% from a year ago. Mike, where is that slowdown coming from?
Yeah, well, our economists have been pretty clear that you would continue to see labor market softness, and in particular, you should see it more in the first quarter, so notwithstanding the current retail sales activity. So their expectation is that you can get a sub 100K non-farm payrolls print in the first quarter of next year, and that starts to change the way the Fed's talking about the market. And I think when you bring it back to where the opportunity is, based on that, we think it's really in the bond market because of that, in developed market government bonds and in high-grade credit, because the central banks are trying to kind of navigate this last mile of reducing inflation, whether or not they can engineer a soft landing accordingly, or it's more of a hard landing. Our economists think it'll be a soft landing. I think the equity market's largely priced for that already. Bond markets aren't, and so we think you can get a lot of good total return and income from high-grade bonds.
Michael, your standout call is on inflation. As a house at Morgan Stanley, you seem to believe it's going to fall much faster than even the Fed anticipates. What kind of numbers, Mike, are you thinking about, and what's driving that?
Yeah, well, listen, I think we've got a couple of important data points in the next few weeks that'll kind of key what we think is going to happen in the first quarter. But suffice it to say that we think between now and the June meeting, you're going to get enough data that shows both deceleration in inflation and deceleration in the labor market that gets the Fed to start communicating that it wants to pursue an easier posture. I don't think you're going to see that in the near term, but so I think this is really kind of a first quarter event that has to play out in the data then.
Mid-December, projections from the Federal Reserve next month, Lisa, they're going to be absolutely critical. Do you think that's a best guess from the Fed? Or do you think it will be a tool used to signal to the market no cuts coming anytime soon?
I think they try to use it as a bit of both. I mean, they're constantly revising the forecast, and in the intermeeting period, or in the intra-dot period, if you will, they're coming out and saying different things, right? So there's an element of this is our best guess, and we're changing it as data evolves. And there's an element of we don't want the market to get too ahead of itself. I mean, one of the things that came out of the last meeting was the idea that the market had sold off quite materially on the rate side, and that acted like a Fed hike. So it reduced the amount of effectively Fed hikes that they had to deliver to the market. Now that's been completely unwound. So they're going to have to sort of balance the message and say, hey, look, now that those hikes have been unwound, and therefore, we may have to be more responsive if inflation was to reaccelerate. That's not our view, but I think they use it as.
We've lost Lisa Hornby there. We're going to try and reconnect with Lisa and come back to her. Lisa, a bit of a spotty connection with you. Just bear with me and we'll try and work that out. Mike, I want to come to you and talk about thresholds for rate cuts. Standard Chartered are saying 4.5% unemployment, 3% core PCE. Mike, does that add up to you?
Yeah, I don't know that I'd subscribe to those specific numbers, but what our economists are targeting is that the Fed starts to change its tune once you see a sub 100K payroll print, and they expect that to happen in the first quarter. And then I think the reaction function from there is that you get a 25 basis point cut in June. The Fed sort of watches and waits to see if the growth, if the data continues to decelerate, and then kind of picks things up again in September. So the labor numbers are the ones that we're focusing on most specifically and that we think the Fed's most sensitive to.
Lisa, apologies for that. I'm told that connection's been re-established with you. It's a little bit cleaner now. Can I come to you on the same question, Lisa? Thresholds for cuts. What kind of numbers do you think we need to see before they can deliver them?
I think inflation has to continue to move towards 3%, and the unemployment rate needs to start moving materially higher. We are starting to see it, not material, but the unemployment rate has steadily moved higher, and it's likely it'll actually be above the Fed's forecast either by the end of this year or early next year. So, I think the hurdle is still high here with inflation in the 3.5–4% range. But as you see that inflation numbers start to come down and the data start to soften, I think that hurdle becomes a little bit less onerous.
We'll continue the conversation. Mike Zezas, Lisa Hornby, sticking with us. Your equity market's set up as follows. We're down about 0.2% on the S&P, about 20 minutes out from the opening bow. Let's get you some movers. Here's Abby.
Weighing on futures right now, John. Micron starting out. Let's start there because we did have headlines drop just moments ago. They've pre-announced to the downside, at least relative to earnings. They actually pre-announced the upside for revenue, but for earnings, they're now looking at a range of a loss of $1 to $1.14. The street is closer to $1.04. So investors right now choosing to go with that greater loss than expected. Let's see how the day trades out and also look for an explanation. There were some analysts that were recently positive on this name. Zscaler down 5.6%. The security software maker's billings forecast has missed estimates just slightly. Investors not liking that with the stock into today up 55%. But then take a look at Boeing up 1.7%. RBC has upgraded the shares to an outperform, saying that they're seeing the early stages of a quote unquote significant shift in sentiment, plus strong demand for both commercial and defense business, their defense business. This stock into today up 15%, adding a little bit of weight to it if these gains hold on the open.
Abby, thank you. More from Abigail around the opening bell. Coming up on this program, a weekend full of spending records.
Of course, online is going to be strong. Stores are no longer open on Thanksgiving Day. So what did people do? They shop with their phone. Mobile mattered.
Wrapping up a record 5 days of shopping. That conversation up next.
Of course, online is going to be strong. Stores are no longer open on Thanksgiving Day. So what did people do? They shop with their phone. Mobile mattered. What people are willing to spend on. Give them something innovative, they'll be there.
And they were there. Consumers aren't slowing down when it comes to holiday shopping. The latest numbers dropping just moments ago from Adobe Analytics. Americans spending $12.4 billion on Cyber Monday. A record Monday, a record Friday. Spending increasing 9.6% from a year ago. With the latest, let's get to Simone Foxman. Hey, Simone.
Hey, John. Yeah, a 9.6% growth on Cyber Monday, according to Adobe Analytics. That's even higher than the growth that we saw on Black Friday, 7.5% higher. This overall equates to $38 billion spent through Cyber Week, which started with Black Friday and ended on Cyber Monday. Again, these numbers just breaking according to Adobe, but we're getting more numbers from the likes of Shopify, which said it saw $9.3 billion in Cyber Monday sales. That's up 24% year on year after a really bonkers Black Friday as well. Apparel and accessories, health and beauty, home and garden among the top spending categories. Block, the parent of Square, seeing a 19% increase in transactions on Afterpay. Again, this is the buy now, pay later element coming into play very strong throughout this Cyber Week. Hardware, home and garden, entertainment, and office supplies, particular targets of that Afterpay product. Of course, we're seeing winners like Affirm here. That is also one of those buy now, pay later brands. Shopify appears to be one of the key leaders in this broad Cyber Week. Piper Sandler analysts even downgrading the stock this morning, saying it has an untenable valuation at this point. Overall, Bloomberg Intelligence has said that discounts roughly in line with what we saw last year, with the exception of retailers that have been under pressure like Foot Locker, Urban Outfitters. Overall, though, the message is that in-store traffic has been light. So even though we're seeing these bonkers numbers come out on online spending, we'll have to see how the in-store data holds up. That said, Citi said it actually saw the first increase on a year-on-year basis in traffic since July. So maybe some positive news there in addition to the online.
It's certainly positive, but not complete just yet. Simone, thanks for the update. So record Friday, record Monday, record online. The airports in America, the busiest they've ever been on Sunday, a record for American airports, according to the TSA. Everything's looking pretty good. Lisa Hornby, I'm trying to work out whether this is the final fumes of a spending boom or just another sign of resilience going into next year.
You know, the consumers had a remarkable resilience, but I do think the momentum will start to slow. And I mean, evidence of that is that we are seeing more usage of credit cards to fund these transactions. Credit card balances are at all-time highs. Your colleague was just speaking about the fact that buy now, pay later is factoring into this as well. We're seeing delinquencies across the consumer spectrum, across the full income spectrum, start to increase from very low levels, but increase nonetheless. And to me, this suggests that the consumer has drawn down on those savings. They are starting to borrow to continue to fuel these purchases. That works for a time being while people are employed, while there's income to kind of fuel this. But to me, the momentum should be slowing coming into the first quarter and second quarter of next year.
Mike, we've got to talk about this. The numbers are great. What are the foundations underpinning those numbers? To Lisa's point, are we starting to reach just a little bit more than we were maybe 12 months ago?
Well, Lisa also brought up a point earlier about fiscal policy, which I think is kind of important here, right? There's potentially a tail to some of the fiscal expansion that we had here. Expanded deficits on the U.S. by 1% of GDP, but it's important to keep in mind that that rate of change appears to have stopped. And importantly, a lot of times that was driven by one-time factors, deferred tax collections in many states, for example. Going into next year, once you get through that and you get through the sort of peak ramp up in spending on some of these key bills, CHIPS, IRA, a bipartisan infrastructure bill, then that pace of government spending slows, at least relative to what we had so far. That's going to express itself in the data in the first quarter, in our view.
Michael, you've got tons of experience covering public policy. This is the coverage you used to lead at Morgan Stanley. Let's just lean on that a little bit more.
Sure.
Do you think the outperformance we have seen in the US economy over the last couple of years has been down to one-off factors that will not last into next year?
I wouldn't boil it completely to one-off factors. I think there are certainly one-off supports, and fiscal policy was a part of that. But I think sometimes we hear from investors, they tend to extrapolate that fiscal expansion become kind of a persistent and regular feature of the economy, and we push back on that pretty strongly. We've got divided Congress going into an election year. To the extent that Congress was to need to stimulate the economy, we think that would be very reactive, i.e. after you've seen some pretty bad data already, which again isn't our base case. And then if you want to see fiscal policy further expand after the election, that's going to be contingent on whether or not one party gets complete control and can execute on some of its policies. By the way, Republicans and Democrats got most of the policies enacted they wanted to since 2016 that had a fiscal expansionary impact. So we don't think there's necessarily a lot on the menu that they want to pursue, even if they have the opportunity.
Michael, what kind of fight do you think is going to take place in early 24 over spending? And can we really have a decent call on the economy for next year without a decent understanding of what that spending fight is going to look like?
Well, I think the spending levels were more or less set by the agreement that raised the debt ceiling earlier this year. And I don't see there being much of a consensus to move away from that, despite the fact that House Republicans are obviously interested in pushing those levels lower. But in our view, they really just don't have the votes to execute on something that would reduce those spending levels. So long story short, the spending levels that we know about, we think are the ones you're going to get for calendar year 2024.
Lisa, some of these issues haven't gone away. You go through it in the bond market, and I get the call for the bond market. We've had 3 dreadful years for fixed income, over the last couple of years at least. And into next year, I can hear that constructive view from you, Lisa. But some of these issues haven't gone away. The spending in Washington, D.C., QT at the Federal Reserve, issues abroad, Lisa. Why do you have that more constructive view despite all of that?
I mean, bond yields are at 15 to 20-year highs, so that's definitely part of it. It's particularly if we do have a bit of an economic slowing. You know, we think the Fed is basically out of the way here. We agree with Mike that inflation is probably coming down. That gives the background or the backdrop for fixed income, makes it much more favorable. You know, when you can earn yields like 5.5%, 6.5% on investment-grade corporate bonds, I mean, that's pretty attractive to us, and it's certainly attractive versus any time in history. You know, it's the previous guests were talking about equities and equities reaching all-time highs. That may be, but when you look at things like the earnings yield, the dividend yield, you can out-earn that in a 2-year treasury now. That's pretty unusual. So to us, high-quality bonds, they actually make a lot of sense in a portfolio today.
Lisa, thank you for the update. Lisa Hornby, Mike Zezas from Schroders and Morgan Stanley, respectively. Always great to catch up with you both. Just to recap those numbers, Cyber Monday sales, $12.4 billion, increasing 9.6% from a year ago. Things on the surface look good. Then you get into the details. Buy now, pay later, absolutely booming. Is this consumer becoming stretched? And why wouldn't it be? We've talked a lot about consumer confidence. You hear people saying things like, why isn't the consumer feeling better about itself? Well, go through the numbers. This from Reed Pickett. Gone over these numbers multiple times already this morning. Need to reflect on this a lot. It now requires $119.27 to buy the same goods and services a family could afford with $100 before the pandemic. You look at various items, groceries up 25% since January 2020. Used car prices climbed 35%. Auto insurance up 33%. Rents roughly 20%. Never mind the month-over-month change year-over-year that drives Fed policy. That's the reality for a lot of consumers in this country. Coming up, the morning calls, and later, our next guest thinks the 5K equity bulls have it wrong. David Bianco of DWS. We are about 5 minutes away from the opening bell. Equities pulling back by about 0.1% on the S&P 500. That's the price action. Here's some morning calls. First up, RBC Capital upgrading Boeing to outperform, seeing a favourable setup with strengthening demand next year. Second call from the team at SocGen, downgrading Morgan Stanley to hold, $80 price target, growing increasingly concerned about the company's growth trajectory, down there about 0.7%. And finally, Piper Sandler downgrading Shopify to underweight, saying fundamentals no longer support the company's rich valuation. We're negative there about 1.2%. Coming up, forecasting a lost year for stocks, David Bianco, and why equity markets are heading absolutely nowhere in 2024. That's the bearish view coming up next. Your opening bell just around the corner. 25 seconds away from the opening bell this morning. Good morning to you all. The state of play. We start the week with a small day of declines on the S&P 500, snapping a 2-day winning streak coming into Monday. This Tuesday, we're negative by 0.1%. On the NASDAQ, we're down about 0.2%. Americans are spending a heck of a lot of money. We need to talk about what's underpinning that spending. Is there some weakness to be seen? Some cracks starting to form? There's your opening bell. Switch on the board and get to the bond market. Yields look like this on a 10-year, up a single basis point, 440. In the FX market, the euro approaching 110, 109.79, positive 0.2%, and heading to its biggest monthly advance against the US dollar of the year so far. That dollar weakness is out there. big time in the month of November. In the commodity market, crude up 1%, 75.66. About 25 seconds into the session, your equity market looks like this. Negative here by 0.1% on the S&P. On the Nasdaq, also down about 0.1%. One sector to watch at the open, the US retailers, consumers out in force over the holiday weekend. Abby has more. Hey, Abby.
Hey, John. Well, it does seem like a rising tide lifts most boats because there are far more winners coming out of this Thanksgiving shopping holiday than losers. And we, of course, are talking this today and yesterday about the strength that we've seen over the last several shopping days of growth on a year-over-year basis, somewhere between 5.5% to 9.7%. Depending on the day. There's one clear winner, though, and that is Affirm. From going into today, the stock was up 15%. Today, it's up another 2%. So there's lots of talk about the growth of buy now, pay later, that momentum. As an example, Shopify said that on a Black Friday basis, week over week. So you could say that that's not the best comp, up 72%. But the point is, people are using that buy now, pay later. We also had into today Shopify up 4%. They are saying that their overall period, they saw sales up 24% for a total of $9.3 billion. Really significant dollars. We have Amazon higher, Walmart, Best Buy, Gap, American Eagle, lots of retailers higher. As for the laggards, John, and this is to your point about the strength of the consumer, anything financially related, payment related, that's not called Affirm, into today had been down just a little bit. Small gains on the day, so let's just call it flat. But when you compare that to Affirm, up 16 to 17% over the last few days to these other payment companies, it says maybe the consumer's not so strong.
Amazing. Abby, thanks for that. Thanks for the update. I want to turn to the semiconductors. Let's take a look at Micron. Under pressure after updating its Q1 sales forecast. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Micron shares actually under pressure on the heels of that update, which actually marked up its guidance for revenue. The memory chip maker says that revenue is expected to approach $4.7 billion. The previous guidance had called for $4.4 billion, give or take $200 million on either side. Meanwhile, you have adjusted losses per share now seen at $1. The previous estimate had been for $1.07. So despite that raised outlook, Micron also said it expects $990 million in adjusted operating expenses. That is well ahead of what analysts had penciled in. And you can see some of that negativity working its way through the shares right now. And it's important to note that it's been a tough time for the memory chip industry overall. And there had been growing optimism that maybe demand was rebounding and that Micron would boost its forecast as a result. Obviously, the company followed through with that, but apparently not enough to satisfy investors. Micron shares currently down about 3%.
Katie, thank you. 75 at 10. Let's stick with tech. iRobot shares rebounding after recording their worst day in nearly 3 years. Bloomberg's Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, iRobot shares were down more than 17% yesterday. This after the European Commission issued a warning about its proposed acquisition by Amazon. Brussels issuing a so-called statement of objections, warning that the deal could hurt the overall vacuum market and also that Amazon may demote other vacuum cleaner makers on its platform. Now, this decision was completely unexpected given the Reuters report that we got on Friday, which sent shares up over 30%. That was saying that the EU would approve this transaction unconditionally. This decision, however, puts the EU at odds with the UK, which already gave the green light to the transaction. The US still doesn't have a decision. The FTC has been looking at the deal since September 2022. But this deal is not over. Most merging companies do make changes in order to make the transaction go through. The deadline for this, for approval or not approval from the EU, is February 14th. So we're likely to have either a very happy or a very sad Valentine's Day for iRobot.
Simone, thank you. iRobot up by a little more than 2%. Amazon down here by about 0.4%. I want to turn to social media. We might be getting some IPOs. Reddit is weighing an IPO next year as soon as the first quarter, according to our reporting. On that reporting, Ed Ludlow. Morning, Ed.
Yeah, good morning, John. In fact, a bit more broadly, it looks like early 2024, a little bit of a second IPO window might open up. Our sources are telling us that Reddit is talking with potential investors about listing in the first quarter, potentially, of 2024. Remember, we reported back in January of 2022 that Reddit had started this process. It was talking with the likes of Morgan Stanley and Goldman Sachs, working with them, looking at a valuation of around $15 billion. The reason that I flag our reporting of January 2022 is that Reddit rose to prominence because of the 2021 meme stock frenzy, which you and I remember so well, and yet nothing's happened since 2022, January 2022 at least. 2022 went on to be the worst year for US IPOs in about a decade, and based on the volumes and IPO performance of 2023, we're only just going to surpass that 2022 mire that we had. Other names that Bloomberg reporting overnight are looking at an early 2024 IPO also include Rubrik, which is the cloud and data security startup that's backed by Microsoft. Interesting timing given how kind of underwhelming performance of those September listings has been, thinking, of course, about names like Klaviyo, Arm, and Instacart, John.
The banks just want to see it busier. Much, much busier next year, that's for sure. Ed, thank you, sir. I want to turn to the broader price action now, about 6 minutes into the session on the S&P 500. Let's get the scores up on the screen. We're negative by about 0.1%. DWS Group's David Bianco discussing his outlook for markets, writing this. At over 4,500, we're concerned the S&P is priced for very optimistic expectations on both the macro and micro fronts. Thus, we prefer bonds over stocks. David, I'm pleased to say, joins us right now. David, let's talk about that outlook, and let's start with the broader economy, shall we? The numbers look terrific, tremendous for spending over the weekend. Busiest day on record for US airports. You've heard all this before. Are you seeing cracks beneath the surface, David, to achieve that spending?
The economy's okay. There are plenty of signs that the economy in the U.S. is slowing from the gangbusters growth of the third quarter, and we expect that slowing to continue into certainly early next year. But for the longest time, the U.S. consumer, particularly when it comes to services, and during this holiday season, yes, they're buying some gadgets and baubles. The consumer is strong. The consumer is solid. And that's the reason why we expect a slowing in the economy, but not a significant recession and not a surge in credit costs either. But look, you're right that we do think that the equity market is fully priced. We do see some upside as things go, likely, if they go well over the full course of the year, but there'll likely be turbulence along the way. And we do think that bonds get you to the same destination without all the shaking up that you'd experience in the equity market over the coming year. But let me say one other thing. In late October, we decided to join the bulls for the holiday season, and we did our holiday shopping early. I think we've picked up some things, and you know, at this stage, we'll be looking to see if we want to make any returns early next year. But we like the equity market in terms of the earnings outlook that we see. We think the tech stocks will deliver strong earnings. So you could say the fundamentals are good, and they are. But the valuations are very demanding. There's still plenty of uncertainty along the way. It's true that 10-year yields have backed up from their October highs. But October aside, we're still looking at yields that are basically at 15-year highs. And as the year goes on, next year goes on, we think we'll hear more about the persistency of the inflation fight and concerns about the deficit.
In the near term, David, if I asked you, though, to put you on the spot where the next 5% comes from in this equity market, is it higher or lower? Where's the path of least resistance?
I really think the range bound is a strong range. I mean, some would argue that the market could break out to the upside, and that has happened, and it was led by the mega cap tech stocks. If that were to happen again, I think we already have concerning concentration at the S&P 500 from the 5 largest companies being 25% of the index and over 40% of the major growth indices. You know, it's just becoming very uncomfortable to be that concentrated. So if the equity market were to break out to the upside with continued leadership, I just think you've got too far of a concentrated market.
David, why does that concentration matter if those winners that make up that concentration keep winning?
It's risk. It's risk management. They may continue to win. They may continue to deliver decent returns next year and over the long term. But one has to just keep in mind that you should diversify your portfolio. When you accumulate wealth over a lifetime, you want to protect it over any shorter period of time. And this is why I think investors will turn to active managers who are providing diversification in the asset allocations, suggesting you take advantage of the opportunities in fixed income. And we are looking for some of the alternatives to U.S. large cap stocks in U.S. small caps and still nibbling on foreign equities as well. diversification matters because you simply don't know what the future holds. Let's never forget that.
Talk to me, David, about international. Just sort of dipping your toes. That was a story at the start of the year. I heard so much about the luxury players. Since spring, I think LVMH is down about 25%. That story's faded. When you take international exposure, David, where are you taking it?
Right. Well, we have been trying to take it a little bit more up in quality with preferences for things like European industrial companies. When we've looked at emerging markets, we've tried to stick with the better countries. And yes, we do like a lot of the technology businesses out of China, but there's a lot of political and geopolitical risks around that. When people look at foreign markets, they're often looking at a lot of banks and energy. Those are areas where we recognize the cyclicality. There could be opportunities, but it's still what I would describe as a late cycle environment. We might have a recession, probably do have a small one early next year. So we're waiting a little bit longer before becoming more aggressive on value shopping, either in the U.S. or abroad. But let's keep in mind that there are some great businesses, even outside of the United States, at much cheaper valuations, and I think they're worth putting in the stocking stuffers for the long term.
David Bianco, thank you, sir, for the latest from David and DWS Group. Less constructive at the index level on the S&P 500, but still seeing opportunities out there into next year, internationally, and much more so in fixed income. The broader market negative here by 0.1% on the S&P, and the Nasdaq down 0.1% as well. Coming up, Israel and Hamas extending its ceasefire.
It's a real risk. You have to expect a group like Hamas, a terrorist group, which clearly doesn't abide by laws of war, will try to take advantage of any pause in the fighting for their own benefit. So we're watching that closely.
And we're watching this closely. The latest on potential truce violations. Team coverage up next.
This is Bloomberg The Open. I'm Abigail Doolittle. You're looking at a live shot of the Principal Room. Coming up, an interview with Principal Global Investors Chief Global Strategist, Seema Shah. That conversation at 11 a.m. Eastern, 4 p.m. in London. This is Bloomberg.
The humanitarian pause in Gaza, now in its fourth day, will be extended for another 2 days, through Thursday morning Israel time. We would, of course, hope to see the pause extended further, and that will depend upon Hamas continuing to release hostages. It's a real risk. You have to expect a group like Hamas, a terrorist group, which clearly doesn't abide by laws of war, will try to take advantage of any pause in the fighting for their own benefit. So we're watching that closely.
The White House weighing in on an extended 6-day ceasefire between Israel and Hamas. The U.S. dispatching Secretary Blinken to the West Bank during a moment that appears constructive. Hostages returning. U.S. planes in air carrying clothes, food and medical supplies. Blinken aiming to keep the momentum going. Set to discuss, quote, continued efforts to secure the release of remaining hostages and the need to prevent the conflict from widening. Let's get your team coverage. Katie Lyons in D.C., Bobby Ghosh here in New York. Katie, first to you. Some developments in the last hour.
Yeah, John, the Israeli military and Hamas trading blame this morning for truce violations. According to the IDF, there were 3 separate explosions targeting Israeli troops in northern Gaza that were positioned in areas in which the ceasefire agreement was covered. There were subsequent shootings, according to the IDF, while Hamas also has said there had been violations of the truce agreement without further elaboration. Now, it's not clear at this time what that means for the overall state of the truce. There has been no indication of further fighting or escalation at this point. Overall, broadly, it does still seem that is intact, but that is going to be something we are very carefully watching. Of course, John, in principle, this truce is expected to go through early morning Thursday, and 20 more hostages taken by Hamas are slated to be released between now and then, in exchange for roughly 3 times that amount of Palestinian prisoners be released from Israeli prisons. Also worth noting this morning is Bloomberg's reporting that the CIA director, Bill Burns, along with the director of Mossad from Israel, are in Doha for meetings initiated by Qatar that the Egyptians will also take part in to discuss potentially this truce extending even further beyond just this 2-day extension. According to a spokesperson for Qatar's foreign ministry, they said at a press conference today that the country's aim is to secure a longer truce, though it's worth keeping in mind, John, the Israeli government, Benjamin Netanyahu, have consistently said they have every intention of continuing the war once this brief ceasefire is over.
Bobby, great to catch up with you, as always. Talk to me about the objectives of Secretary Blinken on this 3rd visit, is it, in the last 6 weeks?
Well, he's trying to do what Bill Burns is doing in Qatar, which is persuading all the parties to extend the truce, to get Israel to also, if possible, maybe dial down some of the language that we've heard from partners of Benjamin Netanyahu in his alliance, and also maybe sort of rein in some of the activities of the settlers in the West Bank. Where land has continued to be grabbed from Palestinians, and generally bring the temperature down within Israel, if that is at all possible. He'll also be hearing from the Israelis about their concerns about extending the truce and how much that may allow Hamas to regroup, to rearm itself. There's a lot of pressure on Netanyahu from his military commanders. We've seen some reporting on this, that his military commanders are worried that they may lose the momentum if the truce carries on for too long. And so he has to weigh the relative sort of advantages of keeping the truce going and getting more hostages out, and also achieving the military goals that he has set up.
Given what you've just said, and given the developments of the last 60 minutes, Bobby, just how fragile is this truce going into Thursday?
Well, the longer it lasts, the more fragile it'll get. I mean, 4 days was a sort of fairly contained time. You have two sets of people, two sets of sort of armed groups that are sort of at loggerheads, very close to each other, high tensions, high degree of resentment and anger on both sides. So the risk of things going wrong can only rise the longer this lasts. And so that too has to be managed, both by Hamas as well as the Israeli military, to make sure that if the truce is indeed extended beyond this 2 additional days, then that their own sides respect the truce. Remember, there are also other groups in Gaza. It's not just Hamas and Israel. There's also Palestinian Jihad, some other groups, all kinds of, shall we say, inflammable substances that can that can light the torch and set things ablaze again.
Bobby, just frame that for me a little bit more. Dig deeper if you can. Who has control of these hostages that still remain in Gaza right now?
So this is the big question. Hamas now says, we are hearing through the Qataris, that it does not have control of all the hostages, that Islamic Jihad has some of them. We don't know the exact numbers. We've heard different numbers at different times. Do we believe Hamas when it says this? That's also sort of a little hard to tell. It's very murky there, and there's not a lot of international media that's allowed into Gaza. I personally am skeptical from my previous visits to Gaza and the region generally. The idea that Hamas and Islamic Jihad are operating completely separately from each other, that does not strike me as credible. It's not surprising that Islamic Jihad may have responsibility for some of the hostages, but the idea that Hamas doesn't know where they are, I would take that with a large portion of salt.
Hey, Katie, on so many different fronts, this is immensely complex and difficult. But on this particular front, who are they negotiating with?
Well, the negotiating mediators, in large part, have been Qatar, Egypt, and the Biden administration. The White House has told us, John, that President Biden himself was very closely involved in these conversations around getting the original 4-day truce agreement, and continues to be involved in this going forward, as this administration is trying not just to support Israel, but also very much is pushing for as much humanitarian aid to be allowed in as possible. This agreement isn't just about getting hostages out, although that is very important to this White House. It is also about getting humanitarian aid in, as we are seeing a growing humanitarian issue in the Gaza Strip, with thousands, according to the Hamas Run Health Ministry there, killed as a result of this conflict, and becoming much more politically untenable as well for the Biden administration. There's growing members of his party, John, that are calling attention to the humanitarian concerns, and it raises a bit of a question about the future of Israeli funding on the part of the U.S. government.
Kelly, thank you. An update from Kelly Lyons and Bobby Ghosh. To the two of you, thank you very much. Just to recap the news in the last 60 minutes. The truce still holds, but what we hear from the Israeli Defense Forces, that the framework for the operational pause was violated. I'll go through the details for you. 3 explosive devices detonated adjacent to Israeli troops in 2 different locations in northern Gaza, violating the framework of the operational pause, that according to the IDF in the last 60 minutes or so. Let's get back to the broader markets. About 23 minutes into the session, the S&P 500 negative by 0.2%. Abby, a snoozy morning through much of this morning so far.
A snoozy morning, John, and even though the decline for the S&P 500 is small, we are right now actually looking at something that we haven't seen since October 26th, and that is a 2-day decline for the S&P 500. But take a look at the snooze fest from a sector composition. Consumer discretionary, the worst sector, down 0.6%. Utilities, the best, up 0.4%. So not a lot of action there. More sectors than not are to the downside. As for the month of November, though, over the next couple of days, we'll be highlighting the big winners, and we have many of them. Tech, in the month of November right now, John, is the best sector of the 11 main sectors, up 12.5%, heading, not surprisingly, to its best month since the month of July. Quite a rally we've had.
Abby, thank you. What a rally through this month so far in November. Still a couple of days to go, a few more sessions just around the corner. Coming up next, your trading diary, a sneak peek at the calendar for the rest of this week. Almost 26 minutes into the session, your equity market pulling back just a little bit. We're down about 0.2% on the S&P. That's the price action. Here's the trading diary. Coming up through the day, we'll get US consumer confidence top of the hour. Fed speak, Goolsbee, Waller, Bowman, Barr, all through today. On to Wednesday, US GDP plus earnings from Dollar Tree and Foot Locker. Thursday, another round of jobless claims and core PCE inflation numbers. And finally on Friday, the main event, rounding out the week with Fed Chair Jay Powell speaking from Atlanta, from New York City. That rounds out the morning for me. Thanks for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.